Today is that day where we're the end of this and the beginning of that.
I think we should pause for a moment and think about how resilient the market has been.
We suddenly went to a low growth, no growth environment. For the first time, we're actually seeing the implications.
We've survived so many shocks through a restrictive Fed environment, and that's incredible.
Yeah, it's me, the Einstein of Wall Street, here on the balcony of New York Stock Exchange. We're coming into the end of the quarter, end of the half. It's actually the last trading day. We've got so much going on. We've got Russell reconstitution. We've got S&P. We've got this wild, crazy cloud with aliens circling the world and whatnot. And there's nobody better than the new team of Einstein and Skip to tell you to break this down in a way that my audience never hears, because it's not my angle, but Jesse is one of the smartest people, I think, in the space, and so I'm so excited that you're here.
Oh, that's so kind of you. Thank you.
It's my pleasure. I like
Einstein and Skip.
Einstein and Skip. I love the fact. I love to learn, and I learn every time I hear you. I learn from you. So let's just go back to that day on a Saturday when U.S. and Israel decided to attack Iran, and oil was at 62.5, and GDP was 3.5, 4. So the economy was in okay shape, and we were going through what we were going through. But that was sort of I think we can, like last year, February, March, and April, when we initiated the tariff story, that was the beginning of a 20.8% fall and whatnot. Sure. And this year it was this, right? We go through these periods, and the last 2 years have been big sell-offs. I call them sort of mini crashes.
They have,
right? And I just love I love the forensics on it, and we can sort of talk about how it happened and what your explanation is, and then we can sort of look back, because today is that day where things are going to, we're the end of this and the beginning of that.
Yes, well, I think we should pause for a moment and think about how resilient the market has been. We've survived so many shocks through a restrictive Fed environment, and that's incredible. And I think things are kind of catching up with us. So with the tariffs, we actually just saw that come out of inflation data just now, this past print, which is great. And now energy inflation is showing up, which is those long and variable lags.
Yes.
So what I think is interesting with the price action, oil shot up, just like you stated. The dollar began strengthening, right? We saw gold decline.
Right.
The 2-year increased more than the 10-year, and from a velocity
Explain
standpoint.
that, and what does that mean?
So I like to say that the stock market is the investor mood. It's a function of supply and demand and buyers and sellers. So if you could take a survey of everyone that says, am I going to buy or am I going to sell?
Right.
We don't know.
It's an emotional reaction.
Exactly.
Right.
We don't know what they're going to say. That's why we can't pinpoint price. That's why we look at levels and things like that. The yield curve, or the credit markets, treasuries specifically, I like to say is investor demands.
Okay. I kind of look at it as the economy. I mean, it's like the bigger picture.
Yeah.
That's the first thing you mentioned is a little more on the retail side, and this is more a little bit on the institutional side.
It is.
Because I don't think your mainstream investor is thinking about the yield curve and bonds.
They're not, but they should.
They should. Absolutely.
And I understand why they're not now, because we haven't had to consider them since the great financial crisis. Right. And so we've had interest rates at this lower level. They didn't really matter. Now they matter again.
Now they matter.
They do matter. So I say it's investor demands because it's your decline in purchasing power that we take into consideration in the bond market.
And that becomes real to people.
It
right?
does.
Yeah.
Yes. So if you are expecting more inflation, yields, or people in the credit market are going to expect more yield to be compensated for the inflation and the decline in buying power.
Correct.
Right?
Okay, yes.
You expect more growth. You are demanding more yield to be compensated for that growth, because otherwise it's the little love triangle with the stock market, right? I could go into the stock market. It's more risky if I can get my return risk-free over here.
Correct.
So that's why if we see an increase in GDP, sometimes the yield curve is going to start steepening.
Right.
And then the third major impact of it is if we start issuing more debt all of a sudden, that you tend to see that more on the long end of the curve. Right,
and now we've seen that. We saw that during the great financial crisis, the 800 billion.
Yeah.
We saw it during COVID with the 3 trillion. But have we seen it since then? Has there been credit markets are fascinating because it shows whether there's ease of money borrowing and lend. I mean, obviously, think about it. Everyone should understand this, that when money was at zero, the borrowing rate was at zero. Everybody, look, that was why tech grew to the levels that it did, because people, they're borrowing at nothing, they're fueling their R&D and blah blah. We noticed that the minute we started to tick up on that, all that sort of strength, it's money supply versus whatever, right? Have we seen are the credit markets reflecting what's going on? I know that there's the economy and there's the market, right? And I know that now this is an interesting fact. So for every 10-point increase in the price of oil per barrel, it's equivalent to 1% of GDP.
Okay.
So we went from $63 a barrel and a 3.5% GDP, and then we saw oil rise up to $119.20.
Yep.
It sustained itself above the 115 for a while, and that meant that we actually lost all that growth. We suddenly went to a low growth, no growth environment.
Absolutely.
Now, what did that do? That prevented us from even considering cutting interest rates, because that terrible word stagflation is what happens when you end up trying to lower interest rates when you're in a low growth environment. That's about all I know about economics.
That was beautiful.
Right? But right, and it's a fun thought because it makes sense to me. I love doing that. But so the fact that the bottom line is, to break it down simply, is we have been sustaining oil prices above $110, $15 for the last 8-9 weeks of this conflict. And that is incredibly inflationary in so many different respects. And you just said, for the first time, we're actually seeing the implications of that inflation on markets and on
CPI, PPI, it's all there.
All that stuff. Okay. So now, obviously, the president said, okay, so we're going to knock down prices of oil and everything. We're going to go with growth and inflation. You're never going to feel it. Or I don't mind. I think he actually said, I don't mind inflation. That was sort of anyway, we don't need to start analyzing what's going on in his head.
True.
That's not that important. But the overlying thing is that this market is incredibly resilient. Over the last 5-6 years, everything's been thrown at this market, and we're still trading at record highs. Over the last year, even more things have thrown at this market, and we are still trading at record highs. We are coming into the end of this quarter, and do we feel like is the retail investor feeling? Now, we do know that we've got so many new tranches of people, we talked about it I think before, that are involved in the stock market. Right? There are tens or if not hundreds of millions of people whose eyes are on the stock market, are getting way more involved in their portfolios or their retirement funds or whatever. They're starting to understand a little bit. They're taking control of, I think, their money a little bit more.
They're becoming more educated. It's beautiful.
Which is so wonderful. That's the new retail investor. They came in around COVID. 80% of them got blown up. The few that were able to climb over the wall are here now. They're the smart money that bought in 2025. They're the smart money that bought in November when they made up this AI as a bubble story.
They did.
And I'm wondering whether they were the ones that, if you think about it, in the middle of the conflict, when we were selling off, we were down about 13-14% quietly. Tech was getting hit, software chips were getting hit, and we were suddenly in this, the springtime, sell-off that we were having. And then and the S&P got down to 6,300, and then suddenly, quietly, a Friday showed up, and we were at 7,400 in the S&P. How did that happen? And then 7,600, and then we kept forging higher. My gut was, and I want to know what your opinion is. My gut is that we were not the information we're getting about the war, because for a while there was was oil up, market down, and the reverse, and then we were not getting real. Iran said this, we said this, so there was no real edge that we were getting for us to respond to around. Right. So basically, I think people said, you know what? This war is going to be over when it's over. The lifeblood of this market are earnings, and we beat them out of the park more than 80% this quarter.
That's since 2021.
Right. And I don't want to have happen what happened last year, which is suddenly the president said, okay, enough with the sell side, let's buy the market. And everybody was playing catch up for the whole rest of the year. They were underinvested. I think everybody said around 5 weeks ago, enough of this stuff, I'm going to buy the market, and they bought it, irrespective of the level of the war and the conflict. They just said, you know what, it's going to be over when it's over. I don't want to get caught up with my pants down at this point like I did last year. I'm going to start buying. And that was what took us from 63 to 7,600 on the S&P, up to the 50,000 level, NASDAQ trading record highs, the Russell, all that stuff. And so once again, we're here.
We are.
At the highs of the highs, right? And are you comfortable with where we are, and what do you think?
I'm not,
actually. Do you agree with my explanation of why the market rallied?
I do agree with your explanation as to why the market rallied. I think spot on, absolutely. I think a lot of it has to do with the SaaS apocalypse and some of the Claude code freaking out and things like that, and just getting the underlying bid, because the AI narrative is very real.
Right.
What makes me uncomfortable now is it's the bond market, honestly.
Okay, good. Then that's what I need to understand.
That's what it is. So, because we were below 4 on the 2-year. So the 2-year yield always tries to front run the Fed. So it's trying, that's when we say the bond market is pricing in rate hikes.
Okay, so who's actually, so for an audience that is not that savvy about that, so there's the bond market. Now so it's more like governments and institutions who are buying bonds. I mean, I know people who have a diversified portfolio, we all have a little bit of bonds in our portfolio.
Do.
Right, but a majority of it is like Japan owns tons of bonds and like that, correct?
Institutions,
okay.
yes,
So
and
if you've got a 4-year, you said it's a 2-year?
The 2-year.
Okay, the 2 year is at 4%. That means that if somebody wants to borrow money, if they want to buy bond, they want to borrow money.
They're borrowing. Well, the government's borrowing money.
Right, they want to buy bonds. They're being given 4%.
Yes.
Okay, for a 2-year run.
Yes.
Which is sort of a safety net for people.
It's considered. It's backed by the full faith and credit of the U.S. government.
Right. So if they want a little bit of safety, they know that they can just put some of their money there, and then they can put some of their money in the market with a little more return on investment or a little riskier mode.
Yeah.
But that 4% is that a good level to be at or not, or?
Well, just like we analyze the markets and looks at levels. So right now we've had a hard time to go above 7,500. I don't know if we're actually a little above it now.
Yeah, we're at a record high today.
Yeah, okay. So that's a level that I've been watching.
Okay.
Do this identical thing with the bond market. You can just draw a straight line where you see an area where it constantly is stopping.
Right.
And
it's hitting up against resistance.
Exactly. So 4, I need it to be before 4 because it was well below that before the Iran conflict.
Okay.
And since it hit a new 52-week high, actually, when Kevin Warsh was speaking yesterday.
Okay, wow.
Which I think attributed a lot to the sell-off and I think was more overblown.
Which means so that people were feeling a little bit anxious, so they felt, you know what, I'm going to take my money out of the market because it couldn't be more frothy, right? And I'm going to put it into bonds.
Those were even selling off too because they have an inverse relationship.
Okay.
But so think of it just as investor demand. So you're demanding more yield.
Right.
So there is shorter term, like it had to look more attractive.
Right.
So in order to look more attractive, because there isn't, in order to say, hey, can come over here.
Right.
I have more yield for you.
I got you.
Yeah,
Come
exactly.
and give me your money.
Exactly.
Right. Okay.
So that's where short-term inflation expectations
Where's
are.
the 10? So there's another bond, the 10-year.
Yep, the 10.
Okay, and where is that trading?
So that one we want to be around 4.5, but a little bit under. And the 30-year we want below 5.
Below 5. So that means someone's going to commit a 30-year deposit and they buy some bonds. For 30 years, they're going to get a higher rate, obviously.
Yep, because it's a longer time.
It's a longer time.
Exactly.
Is that a normal range between the 2-year and the 10-year? About a 0.5 to 1%
it is
historically.
It's for this environment. Historically, no, we haven't seen these levels since.
Okay.
The
so
great
these are
financial
high levels,
crisis.
right? Okay.
But it makes sense though because we wouldn't see these levels because we haven't had the Fed raising interest rates since then. So that should not be a cause to concern for anybody saying, oh no, we haven't seen this since the great financial crisis.
Right.
It's no, we haven't raised rates at this level since before.
Well, no, I mean, everyone needs to understand the cycle.
Yeah.
You have to realize, so COVID came along, the market crashed, we needed stimulus, we put $3 trillion into the market. Over 3 months, we were back to even by August.
Yep.
If you go back to the great financial crisis, we put $800 billion into the market over 18 months. It took 9 years to get back to even. We learned our lesson.
We did.
Right? Then you had 21, market rally. 22, we pulled back because we had started to raise interest rates 18 consecutive times. That was aggressive.
Yep.
And then we've had 4 years of back-to-back double-digit gains.
Yes.
And that set us up for this interest rate cutting environment
Yes.
to take money out of the money
Yes.
supply.
Yes.
We've not had the opportunity to raise interest rates because we haven't been there.
Well,
right?
and the bond market did it yesterday.
It did it. It did do it.
The Fed doesn't need to do anything.
Right.
Sometimes the bond market does its job.
So let's talk about, so yesterday was the first time the new Fed chairman spoke and he was part of it,
Yes.
right? I think one of the positive parts of it was that there was for the first time in ages, full consensus.
Yes, there
that was.
was.
Right. The last time it was getting 8-4. There's been so much dissent over the last 5-6
Largest
meetings.
dissent since 1992.
Correct.
Yes.
And so now there was no dissent, right? And so I think that's a good thing.
Including Powell. He was there.
Yeah, I know. How wild is that?
Yeah.
I mean, the whole dynamic of that. It's like a party at the beach that everyone's suddenly playing
true.
friend. They're getting all friendly, right? I'm not taking my ball and leaving the playground here.
Yep.
And now, your explanation. I'll give you mine, but your explanation of yesterday's major sell-off.
So it's when we heard something alluding to quantitative tightening.
Okay, which would mean raising interest.
So, well, not necessarily raising interest rates. That's where this is why I revisit the Great Financial Crisis a lot. So post-Great Financial Crisis, we entered the ample reserves regime. Before that, the Fed funds rate, which is the banks
borrow from each other.
Exactly.
Okay. Oh no, borrow from the government.
Well, no, they borrow from each other.
They both,
You're right.
right.
You're 100% right. Actually, all of that was correct. Yes,
right.
yes. And so, but if they would do that, they adjusted on a day. And so the thing that's actually very tied to the Fed funds rate is the secured overnight financing rate. So when
that banks borrow from banks overnight just for demand deposits or liquidity.
Exactly, the repo market is where that is. So if they have excess cash, so I always think the liquidity system is if you have excess cash or cash, if you have it, you want to earn interest.
Right. You want to lend it.
If you
overnight.
need it,
right.
you have to borrow.
Correct.
And then the way that you do that is treasuries. Treasuries are collateral.
Okay.
So if you need cash, you're going to put up treasuries as collateral. If you're going to earn interest on your cash, then that's when the repo markets come in. The treasuries there is the way you repossess
this literally, and it happens. I mean,
trillions of dollars every day.
Every day. Okay.
It's the little works of the system.
Right. It's amazing.
It's not the same since the Great Financial Crisis, the plumbing of the liquidity system.
Okay.
So when the Fed sets their Fed funds rate, I'm a very visual person.
No, I love that. It's making sense to me. It's the logistics.
Yeah, so you've got the SOFR, which is the secured overnight financing rate determined by the repo market. That is going to match the Fed funds rate almost identically.
Wow, okay.
So then you've got the Fed sets a target. And the way that they influence it. So that target has a floor and a ceiling.
Right.
And then the way that they keep that target intact is their open market operations. So just like buying and selling, you can almost
doors open, doors close. It's just like
well, it's kind of like the green shoe thing. I guess if you to push a stock up, you buy more. To push it down, you sell more.
Right.
Same concept.
Okay.
So you've got the interest on bank reserves. So a bank can park their cash and earn interest from the Fed, or they can go lend it in the repo market.
Right.
And so the way that keeps a floor is if you're not going to give out money for less than you could earn just sitting there.
Yes,
so that's how it kind of stops it. Because you don't want it to fall through, because then the Fed, it doesn't matter what the Fed does.
There's a bid in the market. And using an old Wall Street term, there's a bid in the market.
Exactly, yes, exactly. And then on the ceiling here, and that's only for banks, and then it's the reverse repo facility for money markets, non-bank financial institutions. And then on the ceiling here, this is actually the discount lending window, which is super bad if banks use that. And then the standing repo facility that actually wasn't implemented until 2021. So these are things that, but that's what I'm trying to say, is it's different now. The liquidity system is very different. So why this is important
was that because of something that happened during COVID or the Great Financial?
2019. 2019.
Okay.
Do you remember when there was a corporate tax payments are quarterly?
Okay.
And in order to access those corporate tax payments, you usually sell out of a money market.
Right.
And so if money markets need cash, they go to the repo market.
Right.
They did not have this alternative. They only had the repo market.
Right. Okay.
And so the repo market shot up to 10%.
Right.
The Fed funds rate was not. That was well above the target range. We haven't seen that. I don't even know, 70s? I don't know, long time, really long time. And so they had to set a ceiling. And so they did that with the standing repo facility just to give money markets an alternative option. But in order to have this for money markets specifically, so like this will connect all the dots. Retail participation.
Right.
You put cash into your brokerage account, it goes into a money market, and it just sits there.
Right.
Money markets, only banks have these options. Now money markets need it because more people have it. The public has it.
Yeah.
So in order to keep this floor, and because treasuries are collateral and they're doing it from the Fed, they need treasuries on their balance sheet. So that's when they introduced ample reserves regime was post 2008. Stand-in repo facility started from the 2019 tantrum. So we need a ceiling on this. If there's 10% that blows past our target, that's going to kill the consumer.
Right.
And so my concern is now with what Worsh said yesterday, is if you look at the use of that, it's kind of empty. And which if there's no liquidity, it's hard to go higher. And that's what Kramer and I we're talking about with the deepened liquidity markets. So then that brings me back to what I'm seeing in the yield curve and the treasuries.
Right.
If I see the 2-year spiking that high,
right,
and markets.
You mean four and higher?
Higher than 4 on that 2-year.
Right.
Which we don't have posted anywhere. That is dangerous levels. But if It's also, I've noticed with markets, and I'm sure I'd love to hear your opinion on this, it's the velocity that matters. We don't like shocks. We like shocks. Shocks to the upside, shocks to the downside, but it's something that we don't expect.
Well, so we say the market can handle anything except uncertainty and surprises.
Yes.
Right? And a shock is a surprise.
It is a surprise.
We will figure it out, but it's, there's so many, I think we really need to acknowledge that this is not your grandfather's stock market anymore.
No, it's not.
There's so many different tranches of people and businesses and banks and third parties, fourth parties, fifth parties involved in the market, right? It's like
the mechanics are different.
The mechanics are different.
They didn't have those
Think
before,
about it,
yeah.
like that next day short-term option, the 1 day thing. There's,
Yes,
what's
that's true.
amazing
0 DTE
about the
options.
market is that they're always looking for things for people to invest in, like
Yes.
how they went from ETFs. When I'm sure people think, oh, ETFs are here forever.
Yeah.
Right. Like, sure, we had the S&P and we had the Q or whatever, but they're always trying to figure out new ways to, for people to, it's so complicated.
It is.
There's all the components that go into all of this stuff. It's almost, that was why I think when we had the government shutdown and we were sitting there going, and there's so much information we weren't getting.
Yeah.
And that was like, the market that was a shock.
That is a shock. And,
Right.
and it leads to uncertainty.
And
Uncertainty leads to volatility.
Correct. And then you see the VIX do what it does, and
Yeah.
then the market goes into sort of a crazy frenzy.
It does.
Look, I think yesterday's sell-off was a couple of things, and we don't have that long we can chat. But
Yeah.
so we're coming into Russell reconstitution.
Yep.
We have the
Okay.
S&P rebalance. We have option expiration. We have the end of the quarter, end of the half. Oh my God, so much going on. However, we know by the charter of a lot of these large funds, mutual funds, institutional, whatnot, have to have certain percentages of tech and chips and this.
Rebalancing.
Okay, right. And so think about this, that there's been such a massive move. Like these are markets that are there's the irrational enthusiasm. When they love a stock, they buy it up $50. In the old days, earnings were coming out, you liked it, you bought it, $3. After the earnings came out, it went up $3, you sold it, everybody buy the rumor, sell it, it was fine.
Yes.
Now, if they love it, it's up $50.
The momentum is insane.
But on the downside, the pain and it's not a very forgiving market. Like Broadcom, they did not miss their earnings. It was a slightly light guidance call, and they were down 18%.
Which is...
And so, what is that a function of? That's a function of the absolute swath or the expanse of when they buy it, they just buy it. They hit a button. It's not like in the old days. I would get an order to work an order. And I would try to do the best. I'd try to buy it within a quarter or half a dollar.
Sure.
Now, if they want to buy it, they just buy it. They hit a button and it sweeps up to where it's got to go.
Yeah.
If they want out, see, that's the level of surprise, the speed and volatility of the thing, and all of that. They just want out. They don't want to sit around because they know it's probably just going to get worse. They want to be the first one. They hit the button. Broadcom is no longer attractive to me because of this. I want out. I'm not going to work the order. I'm not going to spend 3 weeks trying to figure this out. I'm going to hit a button. I'm out.
Yeah.
And so what ends up happening was everybody got in on January. They bought their 13% of tech, 15% of chips, whatever, their allotment by charter, what percentage. And these stocks are now up 10, 20, 30, 40%. Mm-hmm. And so just by definition, they are now overweighted.
Yes.
Right? They're way over their skis.
Yes.
And as of tomorrow, close of business, today, I'm sorry, not tomorrow,
yes,
they have to get back to that 13% or whatever it is. I'm using hypothetical numbers.
Yeah.
And I think yesterday was an example, besides the Fed. All these components affected yesterday.
I agree.
But I kind of think people had to shave off their positions just the way we have to realize that one of the things I do is I trade the closing bell. At 2 o'clock, we posted $5 billion for sale, which it's not the biggest one ever. Probably 8 billion is, but that's pretty big.
That's high.
And if you remember yesterday, 2 o'clock was the high. And the minute we posted 5 billion for sale, yes, the Fed was talking and all these other things. But from a trader's perspective and somebody who's actually trading the volume that's here on the NYSE, that was it. People were selling and they had to get out.
That's the answer. That's the data.
That's the data.
That's the data, and the data doesn't lie. And that's why I always go back to it. So that
data doesn't lie. You were so right.
not.
And that's amazing at
It
the
is.
end of the day. And that's why, look, if you have a clear, transparent Fed that's disseminating that information, that's probably one of the problems with the administration. No disrespect to the big guy, but because the information is sort of skewed and it's muddled, right? When you have clear information, then that's something I can bite my teeth into.
Yeah.
But if it's like he said, she said, or this or that, and all, then I it's not an even playing field. If every time I get to the goalpost, they move the goalpost, then that's problematic.
It
and
is.
I kind of think, look, let's hope for one thing out of this new Fed chairman, and I love Powell. I think he navigated us through 5 of the hardest years ever, and we still were trading at record highs. So all kudos to him. He was amazing.
Yes.
Amazing. Pow, pow, pow to the moon. Hopefully this guy will, but he was also up against a lot of troublesome environment and landscape.
He sure was.
Or
It was
ecosystem, but very, and he handled himself well. Right? I mean, to be standing there with his hard hat on that day and being called a dope, that's not my style.
That's a difficult situation.
That's not my style.
Yeah.
So hopefully the transparency of the data and getting the data in a timely fashion will be the secret sauce that this new Kevin offers us. And then we will look. We're not looking for maybe we're looking for a little bit of stability in the market. Maybe we're looking for that it's an even playing field, so that we can sort of get back on track, because it's been a wild ride. And I love the wild ride. Trust me, I thrive off the wild ride.
That's why we're here. It's a roller coaster. It's great.
So I don't think that's going to change. If when this ball drops, something else is going to pick that. And so I'm excited about that. We're going to end up. Look, we're going to be out of this confrontation, or or war, whatever you want to call it. We'll move on. We're going to the forensics on it. I think we should meet in 2 weeks and look back at. Obviously, we can bring up SpaceX because it did affect the oil. I'm not talking about disclaimer. I'm not talking about any individual stock. I'm talking about the effect that whole ecosystem had.
A big market cap on the stock. Yep.
Correct. The richest man in the world, the smartest man in the world, and the biggest IPO in history, and how it's affected so much of the economy. It's like not one stock does not affect the economy, but this one did. So for us, you and me, to get together in 2 weeks and do the forensics on the last 2 weeks on the effect of that stock that will remain nameless, the new Fed chairman and his explanation.
I think that'd be great.
What we always say after a Fed meeting is the first day is the emotional reaction.
Okay.
And
I agree
then
with that.
Yesterday, I think it was also what we just discussed, the contributing factors around the reallotment or the rebalancing of it. Today, the day after, though, is where the market starts to understand what was spoken about yesterday.
And it recovered.
And it recovered beautifully. We are now trading at record high.
But the 2 years still high. That does bother me. But what I do think, you remember Powell said we're looking at alternative information. He said it a while ago. So I don't think it's anything too abstract to look at different data, because Powell did it already. Right. He said he was looking at Uber for reopening, or Resi, or things like that. So we are a world with a lot of data, and sure, surveys might be outdated, but I think the market did overreact to that, and there are a lot of tailwinds. Inflation I'm going to make a bold statement here. It looks like it's peaked.
Yeah. Okay. Well, that would be good, because I'm not sure I agree with you, because I still think once all of this happens and oil gets back to a reasonable level, we may see it.
Tariff
absolutely.
Inflation there's one data point. One data point does not make a trend.
Right.
But
exactly. And one day does not make a market. We've got to end. You are a pleasure. We're going to meet back here for the forensic. This is Einstein and
Skip.
Skip and Einstein. I love you. The Einstein on Wall Street. I'm out of here. Have a nice day. And that's all I got to say about that.